Hi everyone. Thanks so much for joining tonight's webinar. Over the next 1 hour or so, we'll be going through this topic about SPACs. What exactly are they? I'll be going through a quick refresher, and then we'll look at what are some of the developments within this asset class and what to be looking out for next. So when I was coming back home just now, it was still a bit hazy outside. So good that you're at home listening into this live webinar hosted by the SGX Academy. Hopefully, while you're having dinner, we can learn a bit more about SPACs through tonight's sharing. Okay, my name is Gerald. I'm a SGX Academy trainer. I'm also the founder and CEO of Beansprout. We are a investment advisory platform. You can find us on our website, growbeansprout.com, where we share insights on Singapore stocks, REITs, bonds, as well as ETFs for you to be making a better financial decisions around these different products. Okay, if you find today's session helpful, do join us across our different social media channels as well, where you'll be able to find more regular updates. Okay, and I will start with an overview and presentation, but we will have a lot of time at the end of today's session to be doing a Q&A session. So do go to this website, pigeonhole.at, put in the passcode provided, 10 October 23, and do let us know what are some of the questions that you have, and I'll be happy to be answering them. And just before we start, just wanted to share that tonight's session is really for information and education purposes only. It should not be taken to be financial advice in any case, but hopefully over today's session, we can all become better investors as we learn about what SPACs are. Okay, so what are the things that we'll go through today? Quite a number of things that we will be actually doing an introduction of. First and foremost, I'll do a quick recap around what are SPACs. For those of you who might have heard of this term, maybe last year, what I will actually do is to just provide you with a quick recap around what they are so that we are all very refreshed around what we can do with this particular asset class. Next, we'll look at, say, what are the performance of the US listed SPACs, the Singapore listed SPACs, and to understand the state of the 3 Singapore listed SPACs at this point in time. Next, as the title suggests, we'll look at what is next for the Singapore SPACs. Are they going to announce business combinations? And if they do, what are some of the things to be looking out for? And then last but not least, we'll be taking your questions. So do join the Pigeonhole discussion. And that is something that I hope I will be able to share more about SPACs during the Q&A session. Okay, so we're going to start with a very quick refresher. So either whether you are actually new to what SPACs are, or that you might have come across this term, but you might not be very up to date around what they are. I hope to be able to just do a quick recap so that we are all on the same page around what are SPACs. Okay, so a SPAC is effectively a special purpose acquisition corporation. And how it works is effectively you've got a group of financial managers who come together and using a SPAC, they will raise money through an initial public offering. Okay, a SPAC is also known as a blank check company because the SPAC has no underlying asset at the point of the IPO. And the purpose is really just to be able to find a target company to be able to acquire. So with the proceeds from the IPO, they're actually put into a third-party account. The proceeds can't be used until the sponsor is able to find a company to be able to acquire. So once the sponsor has already found a target, there are 2 potential things that can happen. Number one, if the acquisition is made, the SPAC and the target company will then combine to be able to form a new publicly listed company. Okay, so that is if the acquisition actually goes through. But then if the acquisition is not made, then what happens is that the SPAC is dissolved and investors will get their money back. Okay, so the whole idea behind a SPAC is that it allows retail investors like you and me to be able to gain access to some of these high growth companies before they actually IPO, because of the fact that by looking at what are these SPAC sponsors, which are some of the companies they can potentially acquire, we can actually get a pie of this company that the SPAC is actually looking to acquire. Okay, so in a nutshell, this is really what SPACs are about. Effectively, they are a blank check company which is just there to be able to find companies to acquire. Okay, so the question that you might have is why SPACs versus a traditional IPO process? Okay, first and foremost, one of the perceived advantages of a SPAC is that the IPO process is actually more simple. They do not have to go through a very complex process during the initial public offering because the company does not have any underlying assets as yet. So the due diligence process, the roadshows that they need to be doing wouldn't be as extensive versus if it comes with an underlying asset. Okay, next, what SPACs actually do is they offer certain investor protection. So if you're a retail investor buying into a SPAC, there are certain safeguard mechanisms that are in place, and these are various mechanisms that I will go through in a bit more detail later as to what you can keep a lookout for. Okay, and last but not least, it offers the target shareholders some certainty on the valuation, because if you were to look at some of the IPOs, the IPO valuation can actually change very significantly. If you have been following the US market, we saw the IPO of just about a month ago. And even then, you saw that up till the point of the IPO, the potential IPO valuation was actually changing on a daily basis. So if I am a target company and I don't want to be subjected to some of this volatility, then what SPACs actually do is that they offer the target shareholders more certainty in terms of the valuation. Okay, so there are various companies that have been listed through SPACs. I think the name that all of us are very familiar with would be Grab. Just about 2 years ago, it was listed in the US through a combination with Altimeter Growth Corp. And effectively, it was the biggest SPAC listing at that point in time. So effectively, that is something that all of us would actually have some recollection around a SPAC combination that actually took place. Okay, so having gone through a quick recap around what SPACs are, what I wanted to go through is the SPAC life cycle. Okay, so if you're familiar with investing in Singapore stocks, if you're familiar with investing in Singapore REITs, this is just something that you need to be aware of when investing in SPACs, because it comes with a specific time frame, and this is something that we should all be mindful of. Maybe to a lesser extent if I were investing in stocks and REITs, because they are not bound by this life cycle. Okay, so first and foremost, we have the IPO of the SPAC unit. So if you recall, there were 3 SPACs that were listed on the Singapore Exchange early last year. And when they were listed, effectively, they came through as a SPAC unit. Okay. After 45 days, what happens is that the SPAC unit would be detached into a share and a warrant. Okay, so if you go to the Singapore Exchange website today, you look for the SPAC unit. What you will actually see is, number one, you have the SPAC share. Okay, number two, you have the SPAC warrant because of the fact that they have been detached into the shares as well as the warrants. Okay, so those are actually different entities that are traded on the Singapore Exchange, and I'll go into more detail later as to what are the differences between a share and a warrant. Thereafter, the sponsor of the SPAC will go and look for a target company to acquire. This process can take several months or even up to 2 years. And that is what the SPAC sponsors have been doing over the past 1.5 years. Thereafter, what they will do is they will identify a target. When that is done, they'll make an announcement that we have identified this target and we'll need the vote of the shareholders to be approving the business combination. Okay, so after the circular is sent out, effectively what is done is an extraordinary general meeting will be held as to whether they want to approve this acquisition or not. If the shareholders vote in favor, then the combination takes place. The new entity, which is a combination of the SPAC and the target company, will start trading. But if the shareholders vote not in favor, then what happens is that the sponsors will have to go back to look for another target. Okay, so in a nutshell, this is really the life cycle that a typical SPAC actually goes through. What we have seen for the Singapore listed SPACs is they've gone through the IPO process. We saw the detachment into the shares as well as the warrants. And one out of the 3 SPAC that have been listed have actually identified a target and made the announcement about which company they are looking to have a business combination with. Okay, so we need to be very familiar with this process as a holder of the SPAC shares. Okay, so that may appear very conceptual for some of you. So I've used the example of Grab as an example to bring us through this life cycle. We start with November 2020. Okay, that was when the SPAC, which is Altimeter Growth Corp, was actually listed in the US at $10 per share. Okay, there were various speculation about different companies it can potentially acquire. So we see volatility in terms of the share price, even though no formal announcement was made. But in April 2021, this was when they actually made an announcement that it has identified a target, which in this case was Grab. And then the share price actually went to $15 per share after the announcement. Okay. Thereafter, they took some time to do their due diligence, make sure that everything was in place. And then the negotiations were completed in November. And then the shareholder vote actually took place on 30th November 2021. Okay. The shareholders of Altimeter Growth Corp gave the approval for the business combination. The 2 companies actually combined, which is what we call a de-SPAC, and that took place on 1st December 2021. And then thereafter, effectively, it would trade based on the fundamentals of Grab, and we saw that the share price of Grab came down sharply from the $11 per share at the point of the de-SPAC. Okay, so various points in the life cycle, we see the share price actually reacting in a different way. But hopefully with this, we can actually have a better understanding around what a typical life cycle is like for a SPAC. Okay, so earlier I spoke about investor protection. So I also wanted to spend some time to do a quick recap around what are the different protection mechanisms that are in place for a holder of the SPAC shares. So number 1, redemption rights. Whether you choose to vote for or against the proposed business combination, you can choose to redeem your shares for cash, given that they are put into the escrow account before the completion of the business combination. Okay, So first and foremost, that is a very important investor protection to take note of. Next, you have a voting right as a shareholder. So the completion of the business combination can only proceed if more than 50% of independent directors approve the transaction and more than 50% of shareholders vote in favor of the transaction. So if you recall, based on the timeline that I shared earlier, after the circular is sent out, an EGM will be held. And at the EGM, we actually need more than 50% of shareholders to vote in favor of the transaction before the business combination can take place. If you have less than 50% of shareholders voting in favor of the transaction, then the business combination will not take place and the sponsors will have to go back to finding another target. Okay, so these two investor protection mechanisms are very important, and they are a mechanism that is built into SPACs to be able to protect investors of SPACs. Okay, so number one, redemption rights. You can actually choose to redeem your shares for cash before the business combination is completed. Number two, you can vote for or against the business combination, and the business combination can only take place if more than 50% of shareholders vote in favor of the transaction. Next, we have a few other requirements. So number one, the SPAC sponsor will have to put at least 90% of the gross IPO proceeds in an escrow account. Some of the SPAC sponsors in Singapore put an amount that is even higher than 90%. So that provides you with an additional safeguard in that even if you were looking at a liquidation or a redemption, then you would be able to get a significant amount of your money back. Okay. We also have a permitted time frame to complete a business combination. So the SPAC sponsor cannot take their own sweet time to be looking for their ideal business combination. They cannot wait till better economic conditions because they need to complete the business combination within a certain period of time. Okay. There are other safeguards as well, such as the dilution from warrants, the moratorium for relevant shareholders, and I'll use the example of how Singapore SPACs compare to US SPACs to be able to highlight these investor protection mechanisms. Okay, so we talked about some of the protection mechanism earlier. So once again, this is a recap. If you have already been following the US SPACs closely, this is how the Singapore rules actually differ from the US rules. I spoke about the fact that they need to complete the business combination within a certain period of time. So in Singapore, the limit is 24 months and the potential for them to extend for another 12 months subject to certain conditions. So for example, if I were to have the listing of the SPAC on 1st Jan 2022, that means that I will need to complete the business combination by December 2023, or otherwise I'll need to get the approval to be able to extend the time frame to be making my acquisition. Okay. There's also a need for an independent valuer for the business combination. This is compulsory in the absence of PIPE financing, but if there is PIPE financing that comes in, then the need to appoint the independent valuer would not be required. Okay, if you are not familiar with PIPE financing, that is something that I'll go through later when we talk about what happens at the point of the de-SPAC. I spoke about some other protection mechanisms earlier. So first and foremost, there's this thing that is called the sponsors promote, which is that the sponsors are entitled to shares on more favorable terms to be able to incentivize them to actually find a good target. In Singapore, the limit is 20%, but in the US, there's no limit. Last but not least, there's a moratorium on the sponsor shares from IPO to the de-SPAC. So in Singapore, there is a 6-month moratorium post de-SPAC, and further 6-month moratorium thereafter on 50% of the shareholders. So what this means is that after the de-SPAC actually happens, the sponsor cannot sell their shares actually within 6 months, and that effectively would make their interest more aligned with us as an investor, because it will be in their interest for the target company to be doing well as well, since they can't sell some of their shares post the de-SPAC. Okay, so those are really the key differences between Singapore as well as the US SPACs. But hopefully using this comparison table, we have a better idea around what are some of the protection mechanisms in place for investors of SPACs. Okay, so earlier I spoke about the SPAC actually splitting into a SPAC share as well as a SPAC warrant. For some of you, you may not be familiar with warrants. So I wanted to do a quick recap around what warrants are as well. If you go to the SGX website, you'll be able to see the warrants of the SPACs being traded as well. So effectively what a warrant does is that it gives you the right to purchase additional shares in the company. Okay, so the whole idea is that it can help to enhance the potential return to investors for agreeing to have their capital held in the trust account until the SPAC completes a business combination. Okay, so if you go to the SGX website now, you'll be able to find a share, you'll be able to find the SPAC warrant, and each of them effectively would be the product that different investors can consider based on their different investing strategies. Okay, so I will actually compare what the SPAC shares are versus the SPAC warrants, just in case you are looking at the shares and the warrants and wondering what is the difference. So earlier we talked about the redemption feature for SPAC, and that is only applicable to the SPAC shares, but not to the SPAC warrants. Okay, so remember, as a holder of the SPAC share, you can redeem for cash prior to the completion of the business combination. But if you are actually holding on to the warrant, then you don't have such a redemption feature. Next, we talked about the voting rights as a protection mechanism for holders of the SPAC. And once again, this is applicable just to the holders of the SPAC shares. And you can vote on the business combination if you hold to the shares, but you can only choose to exercise your warrants into a share and then vote if you want to. But if you are just holding on to the warrant, then it doesn't come with any voting rights. Okay, last but not least, we wanted to talk about this thing that is called dilution. Because remember, at the point of the business combination, there can be potentially new shareholders that will come in. So if I'm holding on to the SPAC share, that is something that I need to be mindful of, because my shares can be diluted either through the sponsors promote, from the PIPE investors, or from the exercising of warrants. Okay, we'll talk a bit more about these PIPE investors later, but first and foremost, I wanted to highlight this point about the dilution that may come through if you're holding on to the common shares. As a SPAC shareholder, effectively it is less leverage, but if you were to holding on to the warrants, it is a more leveraged instrument, and that will usually mean that it will come with greater risk as well. Okay, if you were to look at the trading liquidity on the SGX, the shares are typically more liquid compared to the warrants. Okay, so if liquidity is important for you, that is something that you need to be mindful of as well. Okay, so with that, I'll just do a quick quiz. You can just test yourself based on what I've shared in the first part of today's sharing. Which of the following instruments typically has the highest risk? Number one, is it the SPAC units? Number two, the common shares prior to the business combination? Or number three, the SPAC warrants? Okay, the answer is the SPAC warrants, because of the fact that the protection mechanisms are not in place for the holders of the SPAC warrants. Plus, in nature, they are more leveraged instruments, and that will present holders with a higher degree of risk. Okay, so with that, I've done a quick recap around what SPACs are, and I'll move on to talk about the different investing strategies relating to SPACs. Okay, so earlier I mentioned that, okay, you can consider a SPAC share, you can consider a SPAC warrant. So we know what are these instruments already, but then the question is, what should I actually consider and what are the risk level and investment strategies that come through with these different instruments, okay? So there are a few different things that we can do with the SPAC share as well as the SPAC warrant. And then at the same time, I spoke about the different time frame of a SPAC, and that presents us with different investment strategies to consider as well. Okay, so first and foremost, we look at buying the common shares before the business combination. So I put this as 3 in terms of the risk level. So number 1, you have the ability to limit some of your downside risk because of the redemption feature that is in place. But then at the same time, the actual risk will depend on your entry price. Because sometimes we can see that the SPACs may actually trade above the redemption price. So what this means is that you might actually still be presented with the risk of capital loss if your entry price is very high. Okay, so that is buying the common shares before the business combination. Next, we have buying the common shares after the business combination. And I would rate this as something that presents a higher risk, because the point to take note of here is that once your business combination has been completed, you no longer have the redemption protection mechanism, and your risk would then really depend on the acquisition target, in that it will trade very much like a stock, and the fundamentals will determine the price that this actually trades at. Okay, so a bit higher risk after the business combination versus before the business combination. Next, we have the warrants, and earlier we shared that it is something that might present higher risk because of the fact that you do not have the protection mechanism. Plus, on top of that, it is a more leveraged instrument, and hence I'll put it as even higher risk compared to the common shares. Okay, so one thing that matters is the point at which you buy into the SPAC, whether you buy the shares or the warrant, whether or not it is before or after the business combination. But the other thing is whether you are buying it at a discount to NAV or whether it is at a premium to NAV. Okay, because remember, you have this protection mechanism, and effectively you are able to redeem your capital for cash that is locked up in the escrow account before the business combination is completed. Okay, so effectively, if I were to buy some of these SPACs at a discount to NAV before the deal is announced or before it is liquidated, then I can also see some of these SPACs as a potential yield instrument, given that I have the opportunity to be able to redeem it at the NAV if it is liquidated. Okay, so that is another potential strategy to be thinking of. So effectively, these strategies will work at different points in time. We've already seen the SPAC unit IPO, so we no longer have the option to be buying the SPAC unit. We have seen the detachment of the unit towards the shares and the warrants. So our options now is whether or not to consider the shares or whether to consider the warrants, and at what point in time do we want to be involved. Okay, so we can buy the common shares before the business combination. We can actually do so after the business combination, and like I shared earlier, it presents us with different amount of risk. You can actually buy the SPACs at a discount to NAV before the deal is announced, or you can choose to do it before it is liquidated. And once again, the timeline that you're coming in at will present different risks and reward for different holders of the SPAC shares or the warrants. Okay, so one of the things I mentioned earlier is to look at the SPACs if they are trading at a discount to NAV, and this is effectively thinking of the SPAC then as a yield asset if it is purchased at a discount to cash in the trust. Okay, so I've given the example here. If you have the SPAC that is trading at $4.90, and this is before the deal is announced, and if I have the SPAC trading up above the NAV after the deal is announced, let's say it goes up to $5.15, I would have actually a yield of about 5% over this period of time. Do note that this 5% yield is actually independent on fees incurred, including exchange and broker fees. But using this as an example, we can see that if it is actually trading at a discount to NAV, then that is one of the ways that we can think of the SPAC. The other way that we can think about it is to think of it in the scenario in which it is liquidated. So for example, if the NAV is at $5 and the SPAC is now trading at a discount to NAV at $4.90, by holding on to the SPAC at over this 1 year period, even if they do not actually make a business combination go up to $5.15, but because the cash is actually held in the escrow account, I know that the NAV is actually $5. Then in the event that it is liquidated, the unit holders will get back this $5, and over this 12-month period, I would have earned for myself a 2% yield. Okay, so this 2% yield may not appear to be very high for some of you who are, say, investing in Singapore savings bond or treasury bills, but I just wanted to share this as a potential investment strategy that we can think about, just in case we see that, oh, some of these SPACs are actually trading at a very sharp discount to NAV. Then we can also think about, okay, how long do we need to hold it for before it is actually liquidated, and what kind of yield it can potentially give us. Okay, so different investment strategies that we have for SPACs, whether is it the SPAC shares, the SPAC warrants, and at different points in time. Okay, so I talked about the different investment strategies, but also wanted to talk about the different risks to consider. So first and foremost, SPACs have no operating history and assets. Okay, so that is something that is different from most other companies that are listed on the Singapore Exchange, where we can actually understand the fundamentals and do our analysis from there. Okay, so because there's no operating history and assets, a big part of actually investing in the SPAC will really depend on the quality and the track record of the sponsor. Okay, and the next thing is liquidation risk. So if the SPAC sponsor is not able to find an acquisition target, then what this means is that there might be some losses due to the various expenses that are incurred along the way. Okay, the last thing I wanted to highlight is this dilution risk, because as a holder of the SPAC share, if they are able to make an acquisition, then there are different new shareholders that might come in, including and shares that are allocated to the sponsors as part of the sponsors promote. You've got PIPE investors that may come in. You've got some warrant holders who may choose to exercise their warrants. So those are the different things that can potentially dilute us as holders of the SPAC shares. Okay, so we'll once again do a quick test. Which of the following can cause dilution for investors of a SPAC? Number 1, exercising of warrants. 2, sponsors promote. 3, PIPE investors. And 4, all of the above. Okay, so as I shared earlier, there are different things that can dilute investors of a SPAC, and all of the above, including the exercising of the warrants, the sponsors promote, as well as the PIPE investors, can all potentially dilute investors of a SPAC. Okay, so having gone through the recap around what SPACs are, we look at the different investing strategy relating to SPACs. We will then look at how has Singapore SPACs actually performed. Okay, so this will be something that many of you are looking at. because of the fact that we have seen 3 of the SPACs listed in Singapore since January last year, and it is now October 2023. So we can actually take a look and see how these SPACs have actually performed. Okay, so for those who might not be familiar, there are 3 SPACs that are listed in Singapore. Number 1, Vertex Technology Acquisition Corporation with the ticker VT1. Vertex has not mentioned what geographies they want to be targeting when they initially did the listing, but at that point they mentioned that there are a few sectors that they are looking to acquire from, and this will include AI. Even before ChatGPT became fashionable, they were also already looking at potential AI targets, cybersecurity and enterprise solution, consumer internet and tech, fintech, autonomous driving and new energy vehicle, biomedtech, as well as digital health. So those are all very high growth industries, and that really goes back to what I shared earlier as to the purpose of SPACs, which is really to acquire high growth companies. Next, we have Pegasus Asia with the ticker PGS. At the point of the IPO, they had said that they wanted to target companies in the APAC region. And once again, a list of sectors that these companies can actually operate in, including consumer tech, fintech, proptech, insurtech, healthcare and medical tech, as well as digital service. Last but not least, we have got Novo Tellus with the stock code NTA, and they had mentioned that the target geography would be in the Indo-Pacific region, okay? And the sector that they are looking to acquire from would be the tech and industrial sectors, since those are the sectors that the sponsors feel they have a competitive edge in, okay? So this is what we know about the 3 SPACs that are listed in Singapore. They have mentioned different target geographies that they're looking to acquire from. They have effectively mentioned different target sectors that they are looking to acquire from. Okay, so next we'll take a look at the price performance of the SPACs. We'll start with Vertex SPAC, okay? We saw that it was actually listed at $5 last year in March, okay? The share price actually came down through most of 2022. This is in line with the correction in a lot of tech stocks that we saw last year. If you recall, the Nasdaq actually fell by more than 20% last year because of concerns around how higher interest rates will affect the valuation of high growth companies. And the concern is that it'll be harder for the SPACs to be able to acquire companies if the valuation of the tech stocks continue to come down. Okay, so we saw the share price of Vertex SPAC coming down, reaching a low of about $4.50. Okay, that extended till maybe about March this year, but we started to see a rebound in the share price, hovering till about $4.70 until September. And then we see a very sharp spike up towards late September. This really came through after the company announced that it has found a company to be able to make a business combination with. Okay, we'll go through a bit in more detail around what this business combination proposed. But at this point in time, we have actually seen the share price of Vertex SPAC actually rebounding over the past few weeks. Okay, next we have got Pegasus SPAC, also listed in early 2022. We did see the share price of Pegasus SPAC coming down consistently in 2022. In fact, between, I would say, July and September last year, it was actually still trading about the 490 levels. But what we do see is that because they have not actually made any announcement on the potential acquisition, so the share price is still at about $4.60, which is lower than what we see for Vertex SPAC. Okay, last but not least, we've got Novo Teller SPAC. Effectively, what we see here is quite similar to what we see for Pegasus SPAC. Weakness in 2022, a bit of recovery in 2023, but still hovering at about the 460 levels. Once again, because they have not made any announcement around a potential business combination. Okay, so three different specs, weakness in 2022 in line with weakness in the tech sector. Vertex spec has done a bit better in the last few weeks because of the business combination that it has proposed. But Pegasus and Novo Tellers actually still at about the $4.60 level. Okay, so having looked at the price performance of the spec, I think what's on everyone's mind is what happens at the point of the business combination. Because remember, the spec actually needs to complete the business combination within 24 months. Otherwise, they need to request an extension for another 12 months. So we are probably at the point in time where some of these specs are quite close to the 24-month time period in which they need to make the business combination. Okay, so what happens at the point of the de-spec? Okay, so first and foremost, you have the listed spec. Okay, so this will effectively have different shareholders, including the spec sponsor as well as the public investors. Okay, so what we see now would be the spec shares, and the cash that's raised so far is to target a company to be able to acquire. Once a target company has been identified, effectively what will happen is this de-spec process starts to take place. Okay, so we have got this target company, and the target company will come with its own set of shareholders as well. We also have another set of shareholders that will come in, which are called PIPE investors. Remember earlier I shared that there are different ways that the holders of the spec shares can potentially be diluted. And one of it is actually through these PIPE investors, which is additional equity fundraising with private investors to fund the business combination. So for example, if the acquisition is at a fairly high valuation, the amount that has been raised through the IPO is not sufficient to actually fund all the amount that's required to acquire this target company, then these private placement investors or PIPE investors can come in to provide the additional equity. So what this means is that once this combination takes place, you've got a number of different holders of the shares. You've got the spec sponsors who continue to hold to the shares. You've got the public investors who come through either during the IPO or along the way acquiring the shares. You've got the target company shareholders. And last but not least, you've got the PIPE investors. Okay, so a number of different shareholders that come in, and that all relates to the dilution risk that I spoke about earlier. Okay, so once this spec combination is announced, what are the different things that we need to consider to be able to evaluate a spec transaction? Okay, so what I will share here is pretty much the same as how I would evaluate a company, in which we need to do our fundamental analysis. Okay, number one, we can look at the company background. What is the company actually doing? How are they making money? What is its market share? So those are the different things that we can do to understand the company background. Next, we have the industry outlook. We shared the different industries that the specs are looking to acquire from. So that tells us that the industry is very important because it allows us to understand what is the outlook for this particular company. Okay, so maybe for electric vehicles, we can see that they are expected to grow very strongly, maybe over the next 10 years. So that may present more opportunities for companies that are operating within this industry as well. Next, we can look at the management team. Just like how we evaluate a company, we can look at whether we are comfortable with the management. Do they have the track record, the network to be able to bring the company forward and grow the company further? Next, we can look at the financial status, whether the company has made a profit in the past, what are its margins like, is it in significant debt, or does it have a healthy balance sheet? So that will allow us to understand what is the financial strength of the company. Last but not least, we can look at the valuation because every company actually has a price to it. So it can be a good company but very expensive, in which it may not be such a good investment as well. So we want actually good companies at attractive valuation. And that's the last point that we will consider, which is really the valuation of this acquisition. Okay. So 5 key things that I will personally keep a lookout for when evaluating a SPAC transaction. Okay, we don't have a lot of time for tonight's session to be going through each of this in detail, but if you are keen to understand more about, say, valuation, I believe there's another SGX Academy session that is happening tomorrow where the trainer can go through some of this in a lot more detail. Okay, so with that framework in mind, we can look at what has been announced by Vertex SPAC. So this actually just came through recently in terms of the proposed business combination with a company called 17 Life. And with this combination, what Vertex believes is that it will be able to find synergies between 2 of the businesses. Okay, so what 17 Life would effectively offer, and this is based on the presentation of Vertex SPAC. There are 3 key things that Vertex actually believes are the strength of 17 Life. Number 1, it is a leading live streaming ecosystem. Number 2, it is leveraging on its live streaming core capabilities. And number 3, Vertex believes that it is a scalable business model with sustainable growth as well as profitability. Okay, so that is the investment thesis that's been laid out as to why it finds 17 Life to be an attractive acquisition to be having a business combination with. Okay, so we can dive deeper to actually understand what 17 Life actually do. Remember the framework I shared earlier around evaluating the company. And so this is where some of these statistics would become important for us to understand the company background, for us to understand the management, for us to understand the financials, and for us to then think about whether is this a business combination that we want to be voting in favor of in the EGM, and whether we are happy to be shareholders of this SPAC. Okay, so number 1, in terms of what 17 Life is believed to be by Vertex, it is a leader in live streaming platform in Japan and Taiwan. And then at the same time, it has got expansion plans in Southeast Asia as well as internationally. So earlier we mentioned that the ability to grow is very important because the SPACs typically look out for high growth companies. So one of the things that was mentioned here is that 17 Life has got expansion plans in Southeast Asia as well as globally. Okay, so some of this can come through from growth in V-Livers, games, live commerce, and those are the areas that the company is looking to grow over the next few years. We can also look at some of the other operating statistics. So here what we see is that it's got a 7,000 contracted streamers globally. The average daily view duration per daily average user is believed to be 93 minutes. Okay, so we can look at some of these statistics to understand whether or not it is a good company. Last but not least, we mentioned about wanting to analyze the financials. So there are some numbers that have been provided, but we'll get a better picture when the circular is out. But at least based on what the company has presented so far, we know that 17 Life has been adjusted EBITDA positive since 2020. Okay, so in a nutshell, that is how we can look at the potential acquisition and using the framework that I shared earlier and picking out some of the key things to be looking out for. Okay, so in terms of how the business combination will work, The purchase consideration is for up to 925 million Sing dollars. And this effectively will put the total equity value of the enlarged group post the completion at between 999 million and 1.16 billion. Okay, so I mentioned that there are different shareholders that will come in. So there's this purchase consideration 925 million. You've got the amount that's in the escrow 60 to 208 million. I talked about PIPE financing, which is effectively private investors that may contribute towards additional equity of this business combination as well. And then you've got the special bonus scheme. Okay, so these are all numbers for illustrative purpose, and the actual numbers might still differ depending on how much the takeout rate is across this different group of investors. But for now, what we do have is a picture of the timeline. Okay, so the public announcement was made on 2nd of October. Okay, and with that, we will be awaiting the dispatch of circular, which is subject to SGX approval. And if the approval is received, it is expected to be in early November 2023. Okay, thereafter, we will have the EGM, where shareholders will vote whether or not to approve of the business combination. And if the approval is received, then the expected completion of the business combination is expected to be by the end of this year, December 2023. Okay, so of course, all of this is still subject to different things, including SGX approval, the shareholder approval. So we will look out for some of these things in terms of understanding whether the business combination can be completed by the end of this year. Okay, so I've completed my presentation. I just wanted to do a quick recap. So effectively what SPACs do is they provide you with an opportunity to invest in private equity arrangements, effectively high growth companies in the form of a publicly listed company. We spoke about the different investor protection mechanisms, including the redemption feature, including your voting rights as a holder of the SPAC share. Okay, we also talked about the different risks, including the dilution risk, because of the different shareholders that can potentially come in at the point of the business combination. So how we should think about SPACs is that there are different investment strategies. I hope I've been able to share some of the investment strategies during today's session. But what is most important is that we need to think about individual objectives, risk appetite, as well as time horizon. As with all investment, we should think about the risk reward of our investment and do not buy on speculation just because we think that the company is going to be making an announcement soon, or that there is going to be some potential news that is coming out. Because most important, we need to think about the risk reward of our individual investments. Okay, if you would like additional materials to write out on the SPACs, do visit our website, growbeansprout.com, or visit the SGX website, where you'll be able to get more details about SPACs as a product.